So if you log into Canvas and you scroll down under Unit 1, Chapter 1, you should see a link called Chapter 1 Practice. And go ahead and click that, and it'll open up. You'll have to click Load Chapter 1 Practice in the new window. It should be on Canvas on the home page. If you scroll down to Unit 1, Chapter 1, you should see a link to Chapter 1 Practice.
Okay.
And then once, move that out of the way. There we go. So once that loads up, you should be able to hit Start Assignment Now. And these are just some examples that I pulled out of the chapter. I don't know, there's only 3, but the last one's pretty long. Just to kind of go over some of the main concepts from Chapter 1. And like I said, we'll kind of talk about it as we go. So hopefully you did the first little Chapter 1 Adaptive Learning Plan, that Chapter 1 Introduction to Accounting and Business. It walks you through the first chapter. So it talked about, the different types of ownership and internal versus external users were some of the big concepts at the beginning. So just kind of as an overview, in this course we are going to be focused on corporate accounting. So we're looking from the standpoint of a corporation. So everything we learn and everything we do in here, and then if you take financial, it's going to be based off of a corporation. So, from your book, it kind of went over sole proprietor, partnership, corporation, those different business structures. So we're focusing on a corporation. So the kind of the highlights of the corporation is, that they have to follow GAAP, those generally accepted accounting principles that you read about. So, we have some principles and assumptions. I'm not going to go over all of them, but it's just kind of good as we go through this, we'll talk about especially some of the principles that are really important, because corporations have to follow GAAP, those generally accepted accounting principles. So as we're going through and doing accounting for a corporation, they have to follow those procedures. So those will carry on through all of the accounting that we do. With the corporation, all of their financial records should be kept separate. Like a corporation is its own legal entity. So it's separate from its owners. Yes, sir.
Are we supposed to pull that up in our assignments?
Yes, yeah, you should be able to pull it up.
I'm not seeing, I'm sorry, not.
Yeah. I'm not getting the practice. You see in Chapter 1 homework.
Did you see it from Canvas?
The start assignment is not yet available. Canvas.
If you click on it through Canvas, did anybody access it through Canvas? Okay.
Yeah, it says start assignment is not available for you to take.
Oh, okay. It's being special, right? Let's see.
Sorry.
Oh, no, that's good. I prefer that you let me know.
Okay.
If y'all can't get in, it's kind of a problem, huh?
Okay, now
Like, what's it doing? No, feel free. Jump right in. Oh, yeah, see, it's silly. Okay. Yeah, sorry, you guys can't access it till next week. I didn't even realize. It changed my dates when I copied it over, and it somehow wasn't going to open it until next week. It's kind of a problem, right? Alrighty. Okay, you might have to refresh or go back through Canvas, but now you should have access. Uh-huh. Yeah, thank you for pointing that out.
that was gonna be my excuse.
Right? They're like, oh, I can't get in. I can't do anything.
There it is.
Okay, sweet. Sorry about that. Try to look over all the dates. I guess I didn't look at the practice stuff. I just assumed it was all open. It's a bad thing to do, right? Yes.
Question. Okay, so the book for this one and the book from my computer class is the same. It'll be the same book.
No.
Because it's Seagate.
It'll be the same publisher, and so you should only have to buy like one code, and it'll work for both.
Oh,
but you'll have 2 separate textbooks, ebooks, or whatnot.
Okay.
Yeah. Yeah.
That's how that works.
Yeah. So now, is everybody in now? So when we're focused on corporate accounting, again, corporations are owned by stockholders. So people buy stock, you know, on like the New York Stock Exchange, for example, and they own parts of the company. So a corporation can be owned by, you know, just a couple people or like hundreds or thousands or whatnot. A lot of times, you know, like your CEO, CFO, the higher people in the company own a higher portion of that stock. Then they have more power, right? They can make more decisions because the stockholders are technically the ones that own the company and they're making the decisions. They're reporting the board of directors who make the decisions for the
Kind of
company.
like franchising? Or-
It's different than franchising. Yeah, franchising is when you purchase like maybe a Chick-fil-A, for example, and so you follow their rules and regulations, but you own it yourself. So yes.
Can you come here?
Yeah.
Because I'm trying to get in there.
Oh, just click open course and it'll pull you in.
And it's gonna be 14 days. But
Yeah, you should still have some time on your free trial. Another week, I would think. Okay. So, when we talk in chapter 1, the big stuff we're going to learn or talk about in chapter 1 is the basic accounting equation, which you probably read over, assets equal liabilities plus equity. And then the biggest thing we're really going to do in chapter 1 is start analyzing transactions. So transactions are just anything that happened in the business where money or goods or services are being exchanged. And the first, I think, 4 chapters, we're going to focus on a service organization. So we're going to look at an organization that is a corporate organization, so it has to follow the generally accepted accounting principles, but it's a service. So it maybe, I think it's like a consulting firm, for example, or it could be like a lawn mowing service or a CPA firm or an airline or something like that. So they're not selling you an actual tangible good, they're providing you a service in exchange for money. So we're going to focus on that in the first 4 chapters as we kind of learn the whole accounting cycle. And then later in the semester, we'll kind of switch over and deal with merchandising company. So that's the company, you know, like your Walmart or something, a lot of retail, where they're buying goods, you know, and then reselling it for a profit. Okay? But that's on down the line. But chapter 1 kind of talks about the different types of businesses. So these first few chapters are going to focus on service industry. Again, we're really focused on that basic accounting equation, so it's important to kind of understand what those different aspects are. So as you're reading through, you know, an asset, what's an example or a definition of an asset? Land, good, very good. Land's an asset. Supplies, good. Any other?
Stock.
Stock is actually an equity, but that's a good one. Good. The cash that's used to purchase the stock, though, that will be your asset.
That's a cash.
Yeah, so cash. You know, led into that one, right? Cash. Hopefully you guys can see this. See if the black marker works. It was not cast very well. So yeah, assets would be like cash, land, supplies. You'll have some prepaid assets like prepaid rent or prepaid insurance, which we'll talk about. And then another big one is accounts receivable. Does anyone know what accounts receivable is? No.
Money you get,
Go ahead.
money you receive.
It is money you
That
receive.
people pay to you.
They are
for
paid
your
to you
service.
for a service. Did they pay the day that you rendered the service?
No.
Good.
They are paying a monthly installment or something like that.
Very good. Yeah. So accounts receivable is basically when we provide services on account or on credit. So, you know, maybe we are a lawn mowing company. I'd like to use that since it's very basic. I don't mow lawns, but I'm allergic to grass. That's my excuse. I make my high schooler do that. So, or the husband, right? If I go around and I'm mowing lawns for my service business, I'm probably going to leave like a note on their door or sit in their mailbox and say, I mowed your lawn, $35, $40, whatnot. They may pay me that day if they're there, or I may say, due within 15 days. So they may pay me next week or the week after or whatnot. So accounts receivable is when we provided the service. So I mowed their lawn today, but they're going to pay me for it later. Okay. So that's why it's an asset though, because it is important that it's money that's owed to us. So it's a value. Because really all assets are anything of value. Anything that has some type of monetary value to our business. Okay. What's a liability?
Accounts payable.
Accounts payable, good. That's our big one, really, that we're going to deal with right now. So accounts payable is a liability. What is accounts payable?
What you're paying your workers. Cash you're paying your workers on.
That'll just be wages. That'll be an expense. But good.
Something that you're paying for your business.
Do what?
Something that you would pay into.
Yeah, it is. It's something we're paying. It's a debt, basically.
Yeah.
Okay, so a liability is really a debt we owe. So that could be like maybe we purchased some asset on account. Okay, so we might have purchased land, and now we have to pay it monthly. That or a mortgage, or like a car, or even just something like supplies. Maybe I ran down to Home Depot and bought some, new blades for my lawnmower, and I put it on account. I didn't pay that day. So accounts payable is a debt or a liability. That's what liabilities. Liabilities are just things we owe. And we're looking at not things we're paying right today, but things we are going to continue to owe. So those are accounts payable. And then our last one, equity. Equity is basically like the money we have in the business. How are we actually getting money into the business? Well, you mentioned we sell stock, right? So stock, that stockholders' equity, is another word for this, instead of just equity, stockholders' equity. When we sell stock, that's one way of infusing cash into the business. So common stock is an equity account. And it increases equity. So every time we sell stock, we're increasing the money or the value of our company. If you think of equity as like basically the net worth of a company. So what's another way we can get money into our business? Well, what do we do? What do we do to get money?
Loans.
Yeah, we mow lawns, right? So that's service, right? The services that we're providing are going to actually increase equity as well. Well, we're going to call that revenue. Okay? So revenue also increases equity. Okay, so when I go and mow lawns and I earn money, I'm increasing my equity. So those are the two main ways to increase, or the two ways we increase equity. We sell stock, which brings cash into the business in exchange for ownership. And then we provide goods or services. In this chapter, again, we're focusing on the services. So we provide services and we earn revenue, which brings assets into the company, right? Either through cash or accounts receivable. But then we also have to pay things out, right? So what are some expenses of a business? What are some common things that I might have to pay for? Sorry, I heard a lot of
Oh.
I couldn't find.
Like lights, like electricity, we gotta run the business.
Utilities, yeah, good. Office supplies, good. Rent, good. And you said wages earlier, right? Paying employees. So those are all like daily expenses that we, or monthly maybe, that we have to pay out. So expenses decrease equity. Okay. So these are monthly things that I'm paying for. So I'm actually getting the bill and writing a check, whenever it comes due. So those were great examples: telephone, electricity, water, gas, cable, Wi-Fi, whatever we need. And then wages, rent, anything like that. Okay. And then the last one are actually dividends. Dividends also decrease equity. So what's a dividend? Remember from chapter 1? A dividend is just money we might pay out to our stockholders as an incentive. So, we have these stockholders, these owners, and we may say, oh, we had a great year, we had a good profit. So I'm going to share some of that profit with my stockholders. And that's paid out in the form of a dividend. It's not a required thing, but companies will do it. It keeps stockholders happy, which we always enjoy that. We want to keep our stockholders happy. So those are some of the main kind of accounts that we deal with, or types of accounts. So it's just important to understand when we're looking at the meat of this chapter, which we'll be looking at transactions and how they affect this accounting equation. There's a couple of things we always want to keep in mind. The first one is, after we log any transaction, that accounting equation has to stay in balance. So assets should always equal liabilities plus equity. Okay, that's one of the biggest things. To do that, you're going to affect at least 2 accounts. So if we're increasing common stock, we're like, woo, stock increased, so equity increased. Well, what else happened? How did stock increase? What was the other side of that transaction? So in that case, cash would be increasing. Okay, you put cash into the business in the form of selling stock. So that's one of the biggest concepts to really remember as you go through any accounting course, actually, that at least 2 accounts have to be affected. It's like our own checking account or bank account. If we spent money, well, we need to know, where did we spend that money? Did I go to Buffalo Wild Wings, or did I go to Walmart, or what am I spending my money on? And that's really important in a business to be able to track. It's important to us, right? I know I go through and track our budget and then cringe at how much we spend on food every month. Like, oh my gosh, food's important though, right? But it's good to kind of know where the money's being spent. And of course, we're not going to get into all the budgeting and planning in this class, but that's one of the most important aspects of accounting, is to be able to know how we're spending our money, so we can maybe trim back, spend our money more wisely. That's a big part of accounting. So we have to know how we're spending our money in order to plan and do it wisely, or to make more money. You've probably seen it, right? You have these $1 million athletes that go bankrupt. So, they have all this money, but they're not spending it wisely. They're not accounting for it. So it's a personal thing, but then for a corporation, it's even more important. Okay, we have to accurately report, because we have to have those reports go to our outside or external users. In this class, we're focusing on the financial accounting aspect. So we're looking at people that care about how much money we're making, like the government, to tax us, right? And then, so you have the IRS, for example. And then you have stockholders. Well, they probably want to know how profitable we are before they're purchasing stock in our company. Lenders, they want to know that we're stable and that we're able to pay money back. And then maybe just our customers too, right? They find it kind of important to know, if I go buy something that has like a 10-year warranty on it, is that company going to be around for 10 more years to actually provide that warranty? Kind of important, especially in these times when retail's down, right? So those are all some of the important reasons why this is so, necessary to a company. So when we're looking at examples, I'll try to remember to kind of hit some of the other highlights, so the important things. So this first one, we're just going to look at some transactions, and we're looking at that accounting equation. And we're going to basically read a transaction that has occurred, and then we're going to say, what element it is, if it's an asset, a liability, or then they've broken it down by the 4 equity: common stock, revenue, expense, dividend. And then specifically which item it is, you know, if it's an asset, is it cash, land, supplies, whatnot. And then whether it's increasing or decreasing. Okay. So they did one for us. So we have Interstate Delivery Services owned and operated by Katie Wire, and these transactions were completed during May. So this first one, we received cash in exchange for common stock. So they identified, you know, we have an asset, cash, increasing. And then we have common stock, which is an equity. It is common stock. It's the same item. And it's also increasing. So whenever money is brought into the company in exchange for common stock, asset, cash, and then common stock are both increasing. And that keeps that accounting equation in balance. Assets equal 0 liabilities plus that common stock equity. So then the second transaction, it said we paid advertising expense at $4,850. Well, what elements or items are being affected if we paid an expense? Expense, good. And what's the other one?
Equity.
Dividends.
It won't be dividends. Dividends are what we pay out to stockholders. It's not liability because we're paying it immediately.
So
Yeah,
what's
assets.
assets? Okay,
Assets. Yeah, kind of my process of elimination, right? Did you say assets? We'll go all the way full circle,
Let me
right?
try something else first.
So assets, which specific item, what asset would be affected here? Not supplies, we're on number 2.
My bad.
Yeah. So advertising expense is being affected, which is an equity account. So what asset is being affected?
Accounts payable.
It's not accounts payable. Paid is kind of your key word here. So paid, what did you do?
Expenses. Advertising expense.
Advertising expense is one part of it.
That's right.
But what did you do? You paid. What does paid mean? Cash. Yeah. Y'all are overthinking it. That seems to trip up everyone. So anytime you see the word paid, that we know cash is going to be going down, right? We're writing a check or we're using our debit card, whatever. Okay, so the two elements being affected there would be an expense and an asset. So the expense, we're increasing our advertising expense. That account is going up. So specifically, the specific expense is advertising expense, and it's increasing. Okay. And then specifically the asset cash, because we paid, and it's going down. Okay, so cash is going down because we paid.
Now I do it.
So
I was like, who's that?
I know, it's like, how does that work? So you might say, okay, well, we have an increase on one side and a decrease on the other. How is that in balance? Well, cash is or decreasing, so your assets are going down. Well, if you look over here, expenses decrease equity. So that advertising is actually decreasing or making equity go down. Okay? So the advertising expense itself has increased. We have a new advertising expense of $48.50. But on our accounting equation overall, it's decreasing equity. Okay, so that's how we stayed in balance there. And we're going to see a bigger example in a minute of that too. Number 3, we purchase supplies on account. So what 2 types of accounts are being affected if we purchase supplies on account?
Assets again.
Assets, good.
And expense.
This one's kind of tricky. So in this case, it is an asset because we purchased supplies. Supplies are an asset. This one's almost kind of a trick question. So supplies are increasing and they're an asset. We can log that one. So asset, supplies, increasing. We're not paying for them yet though. So where would I log it? It's a liability. Good. When we purchase something on account, those are kind of your key words there. When we purchase on account, that means we're not paying yet. We're going to pay later. So that makes it a liability. And specifically accounts payable. and that liability is increasing. So while we're on the topic of supplies, let's talk about it, because someone mentioned that as an expense, which makes sense, right? If you purchase supplies, you're eventually going to use them up, right? Supplies. So supplies are an asset when we first purchase them because they're of value, right? If I buy lawnmower blades and gas and things like that for my lawnmower business, those are assets. They're helping me earn money. However, at some point I use them up. Those lawnmower blades are going to be replaced. I'm going to have to put more gas in my lawnmower. So when we first buy supplies, whether we pay for cash or on account, supplies are logged as an asset. At the end of the month or the end of the accounting period, we have to look at, do we still have those supplies? Because if we've used them, then they're no longer an asset. Okay. And we'll look at an example of this later. But when supplies get used up, then we expense them out. Okay. And we'll take a look at that later. That one's kind of tricky. That's one of the tricky ones in this first chapter. Number 4, we bill customers for delivery services on account. So we provided services to customers and we billed them $14,700.
That'd be another liability.
And that is actually not a liability because
You
we
actually
don't
got your
know.
money, but you actually got because you.
We
Since
haven't
you
gotten our
actually-
money yet.
Yeah, that's a good.
It's not dividends.
It has to be.
It is an asset. And then what would the other? If we
But then it's a
perform
liable
services.
asset.
No. That's awesome. Okay, well let's focus on we provided a service. When we provide a service, what is that? Which account would that fall under? If I go and mow lawns or whatnot, I'm providing a service. Accounts receivable is where we're going to log it. Good. Because it's money owed to us, right? We billed them. Equity. And what is it when I provide services? What kind of equity? Revenue. Good. Okay. So whenever we perform services, that means we've earned money. Okay. Whether they're paying us today or later. So that's always a revenue. Whenever you see services, we billed for services or we received cash for services, that's revenue. And then since we billed them, that's accounts receivable. That's money due to us at a later date. Okay. So that's why we're doing these together, right? So we can learn all of these. They get tricky. So it is an asset, specifically accounts receivable, and it is increasing because we're increasing what's owed to us. And then the other one is our revenue. And specifically, they call it delivery service fees. So anytime you see the word fees earned or service fees, that's just the specific revenue account they're using. Okay.
Revenue just means it's just money that that owes you.
That's accounts receivable. Accounts receivable is money someone owes you. They owe us because we performed a service. That service that we performed.
That's how I was
It's like you have to guarantee that they're going to.
But I see what you're saying, though.
We're looking at, when we say liability, we're looking at it from what we owe only. So it is a liability to take on that risk.
Because they might not pay you.
Right. And we do account for that, but not until financial accounting. So you don't have to worry. In this class, we're going to make the big presumption that it's a perfect world and everyone pays. So it's an ideal, perfect utopian society, right? But yeah, so when we think liability in this class, all we think is something we owe, the company owes. It is confusing then. So revenues are increasing as well. So anytime we perform services, it's always going to be an increase to revenue. It's always going to be an increase to an asset as well. We just have to figure out, did they pay us cash? Or are they going to pay us later in accounts receivable? Okay. And then the last one is an example. We received cash from customers on account, $8,200. So we build them up here, and now some of them are paying us. So we're getting cash of $8,200 for what we built. So this one gets a little, these are all kind of tricky, that's why I chose these.
But it's still an asset.
It is still an asset. What asset are we getting now? Cash. Good. So cash is increasing.
That first one.
So cash is increasing, and then these customers are paying on what they owe, right? So what else is happening there?
Liability.
It's not a liability because it's not something we owe. It's something we've already logged the revenue here, right? We already said we performed the service and earned it. It's not a dividend.
Oh, it's
Go
that's all of them right there.
I know it is.
That's the left.
It's a trick question.
Liability.
Well, here, yeah, it's two assets.
Okay.
It is a trick one, right? It is a trick question. It's accounts receivable because they're paying towards what they owe. It's no longer receivable to us if they're
Okay.
paying it.
Okay. So yeah. So we're not really. So I'm just asking questions.
Sure, no, please do.
I mean, so okay. So of course you're still logging it in because you have to show your records, but in actuality you're not really adding that 8,200 back to what you already billed, right?
No, so the billing, what happens there is look at it this way. So we sent them an invoice for $14,700, and then they sent us a check for $8,200.
And basically we're
So-
just logging in the 8,200 to what we've already had billed.
Yes. So the revenue doesn't change. So basically what we're saying is they owed us $14,700, and now they don't, right? So it decreases their accounts receivable. They now owe us what, $6,500. So that's what we're doing here. That's why accounts receivable decreases whenever they pay it, because we actually have the cash now. So this all stayed on the left-hand side, right? All under assets. So your total balance didn't change at all. You're just kind of moving things around under assets.
Yeah.
So the cash is increasing, and then what they owe us is decreasing. Yeah, it gets confusing. And in your homework or in these little examples, you can always click the check my work. And all those green check marks mean we got everything correct. So that's kind of nice. And I'll show you that. We'll kind of, if we have time, I think we should have time. If we don't, we'll make time. But we'll open up the homework just to kind of show you, you know, how the homework kind of looks.
You look like this.
It looks similar to this. I'm going to scroll down and click the next at the bottom. Okay. So this one, we are just going to look at the effect of the following transactions on assets, liabilities, and equity. So we're really doing the same thing. All three of these examples are really on analyzing transactions, because really that's the big takeaway in chapter 1. So in this one, when we are looking at invested cash in a business. So if someone gave us cash to invest in the business, what type of accounts are being affected there?
These assets, stockholder.
Very good. We're increasing assets, cash, right? Cash is coming in. And they're doing that in exchange for common stock, which is an equity. The stockholders' equity is also increasing. So on that one, you can choose increases assets and increases stockholders' equity. Item B said we paid for utilities that are used in the business. Well, what are utilities?
Electric.
It will be under equity. Good. Yeah, it is an expense, right? Utilities are an expense that we're paying.
Decrease asset, increase liability.
It's going to decrease assets since we're, what are we decreasing?
Stockholders.
Cash. Yeah, and then we're affecting stockholders' equity as an expense. So we are increasing. We're technically, this is where it gets a little bit tricky. We're increasing our expense, but expenses decrease equity. Okay.
Increase assets.
So we're decreasing assets and decreasing stockholders' equity. So again, we're decreasing assets because we're paying, cash is going out the door. A decrease to stockholders' equity because expenses decrease equity. Okay. Everyone got that one okay? See, I can already see from the first one to this one, you guys are it's starting to connect a little bit more. So it just takes time. This first chapter's very important, really. See, we purchase supplies for cash. Well, what type of accounts are being affected?
Increase assets.
We're increasing assets through supplies, right? Supplies are increasing, which is an asset. What else is being affected?
Cash is going down.
Cash is going down. Very good. So we have another asset going down.
So increases assets, decreases assets.
Yep. Yeah, we're increasing assets and we're decreasing assets. Again, because that keeps our accounting equation in balance, right? If one's going up and one's going down, total assets are the same. So there, we increase supplies and we decrease cash. Very good. How about if we purchase supplies on account?
Assets go up.
Very good. Assets and liabilities. Well, assets, your supplies are still increasing, right? And now, specifically, accounts payable is doing what? Increasing or decreasing? Increasing. Perfect. So we are increasing assets and increasing liabilities. So when we purchase supplies on account, accounts are an asset, they're going up. And then what we owe, our debt, our liability, is going up as well. Because we'll pay those at a later date. And the reason we do it this way, I don't think I talked about it earlier. If you read through the principles, the accounting principles, we have the revenue recognition principle and the expense or the matching principle. Those are really important in accounting. So, you know, we see when we purchase supplies, we're not paying for it today, but we went ahead and accounted for it today. That's really the matching principle, okay? And also the revenue recognition principle, when we bill clients for services performed, which, well, similar, we're recognizing revenue the day it was earned, not when we receive cash. So that's what we call like accrual accounting. It basically means, you know, we know we're going to, we hope, again, in this class, we're going to assume. We pay all of our debts on time and we receive all of our money on time. So accrual-based accounting means whenever I perform services, I recognize revenue the day I earn it. Whenever I purchase something, whether I'm paying for it today or tomorrow or next week, I recognize that purchase the day I made it. Okay. It's kind of the same as thinking about, like, you know, if you make note personally when you buy something with a credit card, you know, or you earn money and you're not getting it that day. You know, we earn money. If you work, you might earn money every day, but you don't get money every day, unfortunately, right? They don't pay you every day. It's what you work today. So, you know, it's the same kind of idea. So those are both the revenue recognition and matching principles just state. And corporations must do that. They must follow accrual basis accounting. So they're recognizing revenue the day it's earned and recognizing expenses when they're incurred, even if we pay them later or receive it later. And the last one just says receive cash for services performed. So what's happening there?
Assets will be received because cash is
Good.
going up. And stockholders' equity is increasing as well.
Very good. Yeah, so cash is going up, so assets are increasing, and stockholders' equity is going up. And why is stockholders' equity going up? What specific type of equity is being affected there?
Your revenue.
Revenue. Perfect. So we perform services, we earned revenue. So we're increasing our assets and increasing stockholders' equity. Any questions on that one? All right, good. And again, you can always check your work. Let's see, I thought this next one, I thought I had more analysis. I guess we get into that more next chapter too. That's okay, we'll do these. So also in chapter 1, at the end of chapter 1, it goes over the financial statements. So what we do all throughout the month is we log all those transactions, all the increases and decreases that have happened all month. And then what we basically want to do is put all of those transactions in a way that we can easily show our investors, stockholders, all of that, you know, how we're doing. So we do that through what we call financial statements. So there's 3 basic financial statements. The first one is your income statement. You may have heard of like profit and loss statement too. They're the same thing, P&L for short. A lot of people call it that. Your income statement, all your income statement shows is all the revenue you've earned in the month minus all the expenses you've had. Revenues minus expenses. That's everything on the income statement. Your second one is your retained earnings statement. So on our income statement, we should calculate net income, which just equals revenues minus expenses. So total revenues minus total expenses equal our net income. That's how much money we made, basically. All the earnings we have minus all the daily expenses. So net income equals revenues minus expenses. Retained earnings, all of this falls under this equity right now, okay? Because revenues minus expenses are under equity. Retained earnings is the portion of that net income that you're keeping in the business, okay? Kind of retaining, right? That's what the word retain means. So retained earnings equals that net income that we just calculated minus dividends. Okay, so retained earnings equals net income minus dividends. So really what I'm saying there is under equity, you have common stock, and then those other 3, revenues minus expenses minus dividends, that's how you calculate retained earnings. And that's what our statement of retained earnings will show. So your statement of retained earnings will show retained earnings plus net income minus dividends. So if you think of equity, common stock, and then everything else is retained earnings. Well, revenues increase, expenses and dividends decrease. So it makes sense, right? You're going to take revenue minus expenses minus dividends, and that's your retained earnings. So that's what our statement, our retained earnings statement shows. And then the last one that we do is the balance sheet. The balance sheet just shows that after we've logged all of our transactions, that assets still equal liabilities plus equity. Okay. And then we're not going to worry about, the book kind of talks about the statement of cash flows. We won't get into that. We learned that in financial accounting. It's a little trickier. So in this first chapter, we're kind of getting introduced to financial statements because we're going to see these throughout the whole semester and then into financial and managerial. They're very important. So this is part of the statements that all corporations are required. You know, when they do their annual report, which they're required to produce every year, the net income or the income statement, retained earnings statement, balance sheet, well, and the statement of cash flows are all part of that annual report. So all companies are required to produce these documents. And it really just gives us kind of a snapshot of how the company is doing. You know, did they turn a profit? Well, we can see that in the income statement. Are they keeping some of that profit so then they can invest it into the company and grow? You know, all of these are important. So here they're giving us a list of all the accounts that we have at the end of the month. These are all the account balances. So they put them in alphabetical order, not in account order, which is always nice, right? But accounts payable is our liability account. We owe $25,000. Accounts receivable, again, is money owed to us. So that's $210,000. Cash is an asset. Then we have our common stock. Fees earned is our revenue account. Okay? So fees earned is the money that we've earned, the revenue. And then we have a bunch of expenses, miscellaneous and rent expense. Supplies are an asset. And then we have supplies expense, taxes expense, utilities, and wages expense. So if we scroll down, they want us to prepare an income statement for the year ended. So this is for the whole year. Again, on an income statement, all that's on your income statement is revenues minus expenses. So on that very first line, we're going to put revenues in, or fees earned, sorry, the account fees earned. And they gave us that amount. It's $875,000. So fees earned is $875,000. Then we list all of the expenses. Expenses are usually listed from greatest amount to smallest amount. Okay, that's just kind of the format. You'll find in accounting there's a lot of, we're very picky people. You know, when you're having to balance down to the penny, right, you get kind of picky. So everyone, there's a lot of rules on how things are displayed. So your expenses are all listed here because we're going to add them up. So again, we start with the greatest expense, which I believe is wages. If I look at all my expenses, wages is the biggest. So I start with wages expense, and that is $525,000. Next is rent expense. Rent expense of $75,000. Next one is utilities expense. Utilities expense of $38,000. And before we get too far, I'm going to stop right there. The next highest expense is actually miscellaneous expense, but that one they always want listed last. Try to trip you up, right? So miscellaneous is just like a, you know, when we can't really categorize it as one of the other expenses, we throw it in miscellaneous. So miscellaneous is always listed last. Always listed last, $15,000. So then after utilities, you should have supplies expense. Supplies expense of $12,000. And then taxes expense of $10,000. Okay. So there we have all of our expenses, miscellaneous being the last one, all of the others from greatest to smallest. So the next thing we do is just add up all of those expenses. Okay, so all of those expenses are added up, and you should get $675,000. $675,000. Now, let's just look for a minute at the structure of this statement. All of our statements are going to look, any income statement you see so far is going to look like this. It has the company name, the statement type, which is income statement, and then it says for the year ended April 30th. It could say for the month ended, for the quarter ended, you know, it's always centered here. This right-hand column is always used for totals. So you see fees earned, we only have one revenue account, so it's listed out here. Well, we have several expenses, so we're going to list them in the left column and then put the total out here to the right. So it just helps you kind of line things up. Because when we come down here, we're going to take total fees earned minus total expenses. Which is what, 200,000? That's an easy one, right? I like it when I can do it in my head. Makes it much easier. I don't have to pull out the calculator. That's net income. When what we've earned is more than what we paid out, we have a net income. That's a positive amount. If total expenses was, say, $975,000, then this would be a negative amount, and it would be a net loss. Okay? We could have a net loss, meaning we actually lost money this year. And then when we get a final amount, we always put an underline if we're doing a calculation, and then the final amount gets a double underline. That's just showing it's a final amount. Okay. Any questions on the income statement? It's pretty easy, right? Revenues, expenses. That's all that's on there. The second statement is that retained earnings statement. So again, retained earnings is the money, a portion of the net income that we're keeping in the business. Okay. So we always start with our beginning retained earnings. So we start with retained earnings, in this case at the beginning of the year, which was May 1st, 2017, and it ended April 30th, 2018. And they give us that amount at $145,000. So we already had earnings from last year that we kept of $145,000. We're going to add in our net income. This comes straight from our income statement. So we perform these statements in order. So we do the income statement first, calculate net income. We're going to add that in here, $200,000. And then remember, the only other thing that affects retained earnings is dividends. So if we've paid out any dividends to our stockholders, we're going to show that here. And we did. If we look at our list of accounts, we had dividends of $40,000. I like to put the minus in, and I actually told us to do that. So here they said enter the amount as a negative number if it's, you know, a negative amount. So dividends, we're subtracting out $40,000. Because dividends decrease equity. So then we know we're adding, you know, in this case we're subtracting because we have a line there. So net income minus dividends, that's our change in retained earnings. So 200,000 minus 40,000. In this year, we had a change in retained earnings of a positive 160,000. So all that's saying again is out of the 200,000 that we made in profit, we paid out 40,000 in dividends, and that left us with $160,000 that we're keeping in the business. We're retaining those earnings. So we started with 145,000 in retained earnings, and then we increased that by 160,000. So we would add them together, get 305,000, and that's our new retained earnings. That's retained earnings at the end of the year. Okay. So that's your retained earnings statement. It always follows the same little format. You start with the beginning, you calculate the change in retained earnings, which is net income minus dividends. Then you just add together, and you get your new retained earnings. Any questions on that one? Okay. And then last but not least, we prepare what we call the balance sheet. Again, balance sheet is just going to show that assets equal liabilities plus stockholders' equity. So we list all of the assets. Notice the only difference up here is we just have a date. We don't say for the year ended. This one, the balance sheet always just lists the current date because it's saying as of April 30th, these are our account balances. So assets we have in the company, we start with cash. Cash is always listed first. So it's 146,000. So when you're listing assets on the balance sheet, you always start with cash, and then you look at, well, how quickly can I convert? We talk about what's called liquid or liquidity. So we always list assets on how liquid they are. How quickly can they be converted, or easily can they be converted to cash? Well, cash is cash, so it's very liquid. So cash is always listed first, and then accounts receivable is usually listed second because that's money owed to us. So it's a form of cash. So accounts receivable is 210,000. And then the only other asset we have in this example is supplies. So I made it easy for us. And supplies were 9,000. We add those three up, and you should get 365,000. So total assets are 365,000. And then when I scroll down, well, I only have one liability. That's accounts payable for now. So accounts payable was 25,000. And then under equity, common stock is an equity account. So I would list common stock. Common stock is 35,000. And then the last thing that goes here is your retained earnings. Okay? Retained earnings. Remember, we just calculated this. So you're going to use what we calculated in the retained earnings statement, that 305,000 is what you'll use on your balance sheet. And again, retained earnings is everything else in equity, right? Revenues minus expenses minus dividends. So we really just kind of wrapped it all up into one account. Instead of listing revenues, expenses, dividends, and retained earnings, we just put everything into retained earnings. That's what we just did in those statements. So now we see it there. So total equity is what, 340,000. we have liabilities of 25,000 plus equity of 340 is 365,000. So when you're doing a balance sheet, look, total assets 365,000 equal liabilities plus stockholders' equity of 365,000. So those should always equal, and then you know your balance. We're always happy when our number is equal. It's always a good day. Okay, so balance sheet lists assets, liabilities, and equity, and shows total assets equal total liabilities plus stockholders' equity. And then it just has a little question. It says, what item appears on both the income statement and retained earnings statement? Net income. Very good. Net income is calculated on the income statement and added in the retained earnings statement. Any questions on any of that?
It's a lot to take in.
It is a lot to take in. I agree.
Yeah.
It is a lot.
I don't know why you working as a teacher. You know all that, you go get a way better job than this.
So my husband tells me every day. Every day. He's like, I could quit my job. You could be making like 6 figures. And I said, but I'd have to work 40-hour weeks and like 52 weeks out of the year. I work 8 months out of the year. Yes, sir.
Okay, I don't have the book,
Okay.
so what do I need to do?
You do have access to the book. Let me show you a couple things. So you guys can close out of that if you'd like. I'm going to show you the homework too. But on Canvas, if you go to our Canvas page, as long as you've signed up, which everyone has, under See Now To Information, you can open the ebook.
Okay.
That MindTap reader will open up the book.
Am I registered on that?
So yeah, everyone should have access to that ebook. And then you just click on like chapter 1 to go into it. So you should be able.
Close out on it, or do we just have to exit or something? I don't want to mess
You don't want to mess
up.
anything up. Just you can actually hit submit assignment. Yeah. Yeah.
Well, make sure I want
And then right here, that MindTap reader takes you into the textbook. So if you click it and then click load, you always have to click that load.
So you're
That's-
saying
yeah.
this is
Yes, take it.
And give me like 2 weeks.
Yes. So you should have another week because I think we signed up last Wednesday. So you should have until next Wednesday.
You know.
And then you can click accept. And it should open up.
Oh, I
And then you can close next guys. You exit that.
let y'all
And
know.
then
I need to look like-
you can do the tour if you want, or you can just hit chapter 1 and
She was mad today when she saw me that day.
I
My English teacher.
Okay.
She's so passionate about.
I was trying to say I'll do the homework,
Yes, yes.
but is there anything else?
No, I was just gonna open up the homework and kind of show you guys a little bit. But
Okay.
yeah, we've only got a few minutes left too, so yeah, if you can leave whenever you need to.
Thank
When you're in Cengage, just to show you the homework. So you do want to be working on that homework. It will be due next Wednesday.
We don't come back
So-
till Wednesday, so.
I know. So you gotta be working on it. So how I work, because it is a hybrid, we only meet once a week, right? So that really limits obviously your availability for help as far as in class. However, it will be due next Wednesday night. So you'll have time when you come into class next Wednesday. If you have questions over chapter 1 homework, that's when we'll address any questions. Or obviously we have, 6 more days before then. So I have office hours, we have the accounting tutor, you can send me an email, you can come by. So if you guys are working through this and you get stuck, there's a few options. There is an option usually down at the bottom, like I'm working on this problem and I get stuck. There's an email instructor button. That'll come straight to my email and then I can see the problem you're working on. And you could be like, hey, I don't know how to get number 4 or whatever the question
That
is.
little headphone part is for.
That's for help or that's something else. That's, like technical support. But yeah, if you're working on a problem and you can't figure part of it out, you can click email instructor. Okay.
Okay.
and I get the email, and then I can open up your problem and then email you back and be like, oh, you just need to, you know, whatever you need to do. Yeah, like whatever it is you need to do. Like read the chapter.
Now, who's the account tutor?
Accounting tutor April, and I think she's in there right now. So she's in 221A. So if you just go out of here and down the hall to the left, she's towards the end of the hall, kind of.
Okay.
And her hours are posted there. I think she's here 12:30 to 6:30 on Wednesdays.
$50 an hour.
Free tutoring. I charge $50. But while you're in your homework, just a couple real quick things. There's always a calculator you can open up. And you can also access, like, you can print it.
So we're allowed to print that
So,
off.
yeah, that's what I was about to say.
So we bring it in, we have to put a star next to it, like, can you help us, even though we got it wrong? Okay.
Yeah, and you always have check my work.
I got a question, like on
Sure.
the stuff that you just helped us with,
Uh-huh.
like if I print that, can I use that as my?
Sure, yeah, absolutely. So you have some options. Yeah, always use check my work. And let me go into like an
So
actual,
when you check my work, when I automatically just grade it, so you can't like fix it.
you can fix it.
But it, yeah.
So when you hit check my work, say I'm just put in a number here and I hit check my work, it'll just show me I'm wrong, but I can go fix it. So use
But it
the
only
check
gives
my
you-
work.
But it only gives you like 3 times to check it before it makes the question.
I think I have it on unlimited.
Okay.
Because I want you guys to learn it. So, I mean, you know, try to get it right. But
Yeah, well, I had some other one,
Everything is fine, stop that. I'm like, what do I have to ask?
you should always be able to use check my work. And also, you can always even submit the homework completely and read the feedback and go back in. So if you get one wrong, if you just cannot figure it out and say, I'm like, you know, it's the weekend and you're like, oh, she probably isn't going to email, I'll try to email back. But you can submit your homework assignment and see like how to work it and then go back in and fix it. So it'll save all of your answers. So really, I mean, the goal of the homework is for you to understand the material and make 100. So I give you those opportunities to make 100. So if y'all have questions throughout the week, email me, come by, call me, whatever, you know. If
How do we solve this first one?
yeah, now you know that is not the answer. Yeah, and help each other. Yes, sir.
I'm having a problem with Tom.
Okay, yeah, let me come look at it. Let me stop this real quick.
He's cheated.
Yeah, I was working at that with my homework grade.
Why is this one?